Asia stocks set for a cautious open. Oil holds gains and markets wrap. So, global markets are approaching a key inflation report that could provide insights into the Federal Reserve's interest rate outlook. Asian equities are expected to have a cautious opening, meaning oil prices have been holding steadily due to concerns of global supply shortages. So this also sets up for Japanese and Australian futures suggest marginal declines and Hong Kong's contracts show a slight rise, and the US listed Chinese company stocks are relatively stable. In the US, technology stocks, including Apple, declined, leading to a 1.1% drop in the Nasdaq 100 index, while the S&P 500 slid by another 0.6%. The rise in oil prices is contributing to worries about inflationary pressures. Oil prices reached a 10-month high due to the production cuts by OPEC Plus leaders, resulting in expectations of the tightest crude oil market in the decade. Now, this brings down to Treasury 2-year yields, sensitive to federal actions exceeding 5%. An auction of a 10-year US Treasury notes saw the highest yield since 2007. As investors seek higher compensation for inflation and increase in US government debt supply, the US dollar slightly weakened, while other major currencies traded within narrow ranges. The upcoming Consumer Price Index, the CPI report, is expected to indicate increasing inflation pressures, potentially influencing federal policy decisions. Some market participants anticipate a Fed rate hike in November. Investors are advised to consider reallocating their portfolios in preparation for a potential resurgence of inflation. A shift in the equity allocation of investors has led to increased investment in US stocks and reduced allocation to emerging markets, as shown in the Bank of America survey. If CPI shows a significant increase in inflation, it could impact the rally in financial markets, potentially affecting expectations of the federal interest rate policies and inflation trends. August inflation report likely to show prices heating up again. Over the past year, inflation in the US has dropped from 9% to 3%. But there is a concern that it may rise again in August. Economics predict that the Consumer Price Index, the CPI, will show a 3.6% increase in August, up from 3.2% in the previous month, with a 0.6% monthly increase, the highest since June 2022. Now, rising energy prices are a major contributor to this anticipated price spike, with oil prices hitting their highest level since 2022. The Federal Reserve is closely monitoring this report to assess whether inflation is finally stabilizing. The federal government has raised interest rates aggressively, with an 11 rate increase in the past 16 months in an effort to cool down the economy. However, the report suggests that inflation may not be subsiding as quickly as desired. Core prices, which exclude food and energy, are expected to rise 0.2% in August, or 4.3% annually, well above the federal government's 2% target. The Fed is also considering other economic factors such as job growth and consumer inflation expectations. As August job reports show mixed results, with additions exceeding expectations, but the unemployment rate rising to 3.8%. Wage growth came in lower than expected, which is seen as a positive sign to the Fed's battle against inflation. Most investors expect the federal government to keep interest rates steady during its upcoming meeting in September, with a 7% probability of another rate hike. However, a disappointing CPI report could change expectations for a rate hike in the fourth quarter. So, currently, the CPI report is coming out based on the posting of this video on September 13th, and they're going to make their decision in September 20th. So keep in mind that, as I mentioned in previous inflation reports provided by Jerome Powell, the federal head chairman of the Board of Federal Reserves, so he said that he's planning to raise interest rates one more time after the previous interest rate hike. So if it's not even this month, September, it's either going to be in October, November, or December, because he said it's guaranteed going to be one more. So keep in mind, it's going to be one more, so no need to fight over whether or not they're going to raise it this month, maybe next month, but guaranteed within these past 3 months. And also, he could backtrack. So based on my opinion that If this report comes in as hot as expected, for example, if the jobs right now are going as hot as it usually is for the past couple of months, he could change his mind and decide to raise interest rates until 2024. But if that's the case, then everyone else in the market will freak out and panic. Then that's beginning we'll have a recession instead of a economic soft landing, they therefore say. And also, the CPI report is based on, you have everything besides food and energy. Food and energy, they consider that as another category. Because food and energy, because you have energy prices rising and food costs rising, then of course people will be more stirred. Because whatever income they make are currently living paycheck to paycheck. Where you guys should check out my previous video where I talked about living paycheck to paycheck. So if those prices go up, then it'll affect the population. Like basically makes it even more difficult for people to buy food. And of course, if that's the case, people will start complaining. Now, in this case, when this report coming out, it's gonna be pretty interesting to see what they will do. If they don't raise, then it's okay. Then you can guarantee within October, November, December, within these 3 months, they're going to raise one more time. And based on this report, the economy is giving us so-so, meaning is it could raise interest rates or it may not raise. So far, they haven't solved the problem of supply and demand. So currently, we have a set amount of supply, but we have really high demand. They want to cool down the demand so it matches the level of supply and demand. This includes for housing market. And housing market is not stock prices. It doesn't fluctuate like that. Basically, it's stocks. You can liquidate them really easily. And for housing, it's really difficult to liquidate compared to between the two. And this all relates to inflation at the end. So that's it for this report. I'll see you guys next time. Make sure you guys click the subscribe button down below and a like button. I upload between 1 to 3 times a week, including really news reports like these. If news reports like these come in, then expect extra videos coming in. I'll see you guys next time. Have a great day.